Yeah, hi traders. Obviously, all eyes on what's happening in the Japanese yen, and we are starting to see some pretty wild moves taking place. An element of the market is saying that we are getting closer to that point where the Ministry of Finance will give the blessing to the Bank of Japan to intervene, effectively selling foreign currency and buying back in Japanese yen. We saw dollar yen earlier just trade up to 160. It came back a bit. We've just seen a 150 point rip to the downside. So, the market is getting a little bit nervous. Implied volatility is pushing up, and I can imagine liquidity is thinning out. And it's also probably being exacerbated a bit by the fact that we do have a national holiday playing through in Japan. Now, if we have a look at some of the conversations we're seeing, an element of the market is positioning long of Japanese yen on the hope that we do see the Ministry of Finance in giving that blessing to the Bank of Japan to intervene. The other half of the market is saying, well, now's not quite the time. And while we might see some big punchy moves to the downside, we still need to see a situation where we're going to go past FOMC on midweek and also non-farm payrolls. So a full intervention may not happen for a week or two, and dollar yen may still be another 200-300 points to the upside. But we are on watch at the moment, and obviously those pronounced moves can cause some big duress. So position sizing in the yen pairs is absolutely paramount at the moment. Now, for me, the high probability outcome is staying out and actually looking to buy any kind of weakness from an intervention move playing through, similar to what we saw back in September 2022, where we saw the full intervention playing out. Dollar yen ripped 550 points to the downside, but then over the next 20 days or so, we saw dollar yen going on an 8% rally. And those fundamentals are still there. Nothing really changes from a Ministry of Finance intervention. We can have a look at the Tokyo inflation numbers, which obviously predate or precede what's happening in the national numbers. And we saw them coming out at 1.8% on headline. And the core numbers came out at 1.8%, well below expectations as well. And then Governor Ueda himself came out and said that the impact from a weaker yen hasn't really been felt. Now, if we also have a look at inflation expectations in the market with these so-called break-even rates, which look at average or inflation, how it's expected to average over the next 5 years, we've seen them rolling over a little bit despite the weaker yen, and they currently sit at 1.39% from around 154 last week. It's hard to justify, much more of a stronger yen other than Ministry of Finance. And again, it sort of gives the idea that any kind of weakness playing through in dollar yen will be a buying opportunity. If we have a look at the differential between US Treasuries and Japanese government bonds, which obviously give you that idea about what's happening in policy divergence, back in January, that premium of US Treasuries stood at 3.1.7%. And it currently sits around 380 at the moment. So again, it gives you the idea that an intervention move will be quick and people will look to buy back into that. And that's coincided with a move that we've been seeing in dollar yen from around 140 up to 160. Now, if we have a look at implied volatility in dollar yen, it does tell us that the market is on tender hooks for big movement playing through. Again, comes into our position sizing. We've got 1 week dollar yen vols trading around 17%. Obviously, that does include the fact that we've got payrolls and FOMC. So that's obviously something that's there. Now, something that I think is sort of poo-pooing against the intervention idea is if we look at the premium of volatility of 1 week puts relative to calls, we can see that puts are trading at 2 vol premium to calls. So if we were really expecting massive intervention and a 550 point rip to the downside, those vols would be about 4 or 5 vol premium in puts relative to calls. That's not the case at the moment. And maybe that comes because, as I say, the market is looking pretty whippy, but how much of this is what's happening in liquidity because of the national holiday playing through? So, of course, the conundrum we've got at the moment is position sizing. We need to keep an eye firmly on what's happening there. Do we get another 200-300 points to the upside and the idea that now is not the time to do full intervention, or do we bet for a long yen and the idea that it comes very, very soon, in which case we cause a rip, in which case if it does, then you need to get out pretty quickly because the market could turn very aggressively. So a very tactical situation. But if we have a look at the price action today, it's jumping around and intervention is coming. The market seems to be testing out the Bank of Japan and the Ministry of Finance here.